Hi, and welcome back to the Smart Wealth series where we are exposing smart wealth secrets of the ultra rich. My name is Jeff Sokol. I'm the owner of BeneShield Financial, and I'm the creator of this course and program. And today, we're in video 11, we're going to be talking about infinite banking and the money multiplier system, what we call the money multiplier system. It's a system by which we are able to take a certain amount of income and a certain amount of wealth and move it again and again and again and continually increase our wealth and increase our cash flow. Most importantly, increase our cash flow by using the same by using a certain amount of money and continually borrowing against that same amount of money to add more and more cash flow and more revenue, and ultimately more and more wealth. So the first thing we're going to talk about is how to use this system called infinite banking. All right, infinite banking is a process by which you would use cash value life insurance, which could be whole life or index universal life, that provides you with a growing asset. Okay, so whole life insurance, for example, might pay out 4% per year, 3% per year, and so you know that you're getting a little bit on your money every single year, and it's going to be there. It's reliable. It's set in stone, and look, these things are reinsured and reinsured and reinsured, so that they become safer than banks. Ultimately, is the bottom line. Insurance becomes safer than a bank. So you can borrow against that money that's in the cash value that you have accumulated. You can borrow against it, and then you can pull off of that, and you can start using that to finance your own vehicles, finance your homes, finance homes for other people. And you get paid interest on that. And what happens is that you end up growing wealth very rapidly by using the same methods that bankers use against you. You can use it for you. So instead of you paying interest to the bank, you're paying interest back to yourself, or people are paying interest back to you, and you're rapidly growing your wealth. Okay? So here's a video by Lifestyle Banking. Okay, the name of the company is Lifestyle Banking, and I want to show you their video. This guy does a pretty thorough job of explaining how infinite banking works as far as real estate is concerned. So let's go ahead and watch that right now.
As we said in our last lesson, this system can be used for much more than simply to finance your cars. And if it works for financing cars, how do you think it looks when we finance something even larger, like our home or our office building? And that's exactly what I want to show you today in this lesson, is how to recapture a mortgage and make incredible profits simply by using the whole life insurance policy to fund it and to repay it. And so that's what you see on your screen right now is actually a real life case where Ray Poteet, the founder of Living Wealth and my mentor, went out and he used a policy to finance his daughter's mortgage. And so what we're going to do is build a policy in a very similar way to that Ray built his, and to use it to pay off a mortgage. It can be yours, it could be a family member's. We don't care what it is, but just know that we're going to use it to fund something a little bit bigger than a car and pay ourselves back and see what we can make. So you'll notice we're going to pay premiums and make deposits just like we did in the car example, where we're going to build a policy. And we do that for 7 years, just like we did before, and we stop paying premiums. At this time, of course, it's a little bit of a higher capitalization because we were taking over something larger than a car. Now, you might be thinking, I can't put in $40,000 a year, Nate. I'm not at that level, and that's perfectly fine. The time period doesn't matter. The mortgage amount doesn't matter. If we retook your mortgage in 15 years and instead of 7 years, and you started paying yourself back for the back end of the 15-year mortgage, That's 15 years of payments somebody else would have gotten that you get to keep. It's extremely powerful. So don't get caught up in the numbers. Really, the reason we chose these numbers is because we wanted to get to this amount of cash value right here that you see in year 7. Because that's exactly what Ray had available. He actually had $252,000 almost on the dot inside of his policy to get right at $252,000 in cash value, because that's the amount he had in a policy that he used to go take over his daughter's mortgage. And you'll notice that she had at that time a $206,000 mortgage. And she was making payments to somebody else at this time. And of course, it's not 2 payments back to dad if you're willing to make it back to somebody else. And once again, this could be taking over your own mortgage, could be taking over a family member. The whole goal would be to one day have enough cash value to take over your mortgage, maybe your office building, take over some investments, as well as your children's mortgages, and have all the money stay in the family. And that's what we're hoping to teach, okay? Once again, we show it not paying premiums. Ray never stopped paying premiums. His results are much better than shown here because he continued to pay premiums. But once again, we're just focusing on the mortgage and how much money we can make. And if we added premiums going in, the numbers would just get bigger, but it would also get convoluted. And so we go out and we take over this mortgage, $252,000, and she was actually paying $1,511 and some change that she's going to end up paying back to Ray Poteet, her dad, for the remaining years of the mortgage. And she had just gotten it, so there's about 30 years left on it. Now, $1,511 a month, this is monthly. Actually, if we multiplied it by 12, we get exactly $18,139 for the year. Now, her interest rate, this was about 15 years ago. Her interest rate was 8%. Back to Ray. Now, honestly, her interest rate when she had the loan at the bank was about 6.5%. So he actually increased the interest rate that his daughter was paying. Now, why did he do that? It was so that she could lower her taxes. Mortgage interest is a deduction. So she was able to lower her taxes, but all the money was able to stay in the family. And that extra money went to increase Ray's death benefit and cash value. Who do you think is going to get the death benefit? She will. There was no qualms about it at all. She would much rather keep all the money in the family, have it be built inside of a policy, get an extra tax deduction, and then get the money back tax-free when her father dies. It's pretty much a win-win at this point. So she's paying it back in $18,139 a year. And we are actually right now sitting, I believe, at right here at year 22 in the system. It's about 15 years after they took out the mortgage. That's actually in today's world. That's what is going on right now. And you'll notice that he ended his capitalization period with $252,000. His daughter has put in every single mortgage payment up to this point. And it's gone from $252,000 without any money on his part all the way to $518,000 just by keeping the money in the family for the mortgage. He's got all the money back already. He's doubled his money at this point, and he still has another 15 years left on the mortgage. Are you starting to see what's available to you? And right now he's got 6 mortgages financed, not just one. He's got his mortgage, his office building, his daughter, his other 2 daughters. He's even got my mortgage financed just within this family. And at this point in time, you'll notice there's 15 years left on the note. The payments keep coming in, and for a 30-year mortgage, he ends up with over $1.4 million in his policy, and pretty much the entire thing was funded by mortgage payments that his daughter was going to make anyway. It just happened to be she was going to make it to somebody else. Now, this could also be your own mortgage. You're making more mortgage payments to somebody. Why don't you start making them back to yourself? We can do that if you give us some time to build it. You may not be able to take it over right away, but even if we were to take it over 10 years from now and you make 20 years of payments back in, Think of what we could be making at this point. How much risk has the family really taken? Absolutely nothing. What if Jody, his daughter, had to miss a payment, had some financial struggles, and needed some help? Do you think it would be easier to work with dad than it would be to work with a bank? Most definitely, guys. There's such a power in private family financing or infinite banking that we can have if we bring families back together. And what do you think would happen if I scroll back up and we use the money that we had, the $252,000 here, to go finance a rental property purchase as an investment? And this money right here coming in was just the rents being paid. Think on these things. It's extremely powerful. And so over this time period, if we go down and we do a total of what's actually gone on, you'll notice, I forgot to mention one thing, you'll notice that the starting point really is not the 252. It's actually right after we took the money out in that first year, we had $66,000. So that's how much was in the policy after they funded the mortgage. And you'll see that number down here. So you'll see that right after we took over the mortgage, there was $66,000 left in the policy. At the end of paying off the mortgage, there's $1.4 million in the policy. The only money that added to the policy during that time frame was the principal and interest payments that his daughter was making, And they totaled $544,000. That's the $18,139 times 30. Is that $544,170? And so if we take out the money we had to begin with, and we subtract out the money that was paid in by his daughter, even though that money didn't even come from them, but if we look at the family as a whole, they have $831,000 in profits above and beyond what was paid in payments and what was paid in or what was remaining after the capitalization period and after we took over the mortgage. And honestly, think about the power of this. Let's say it was a rental property or your own mortgage or whatever it is, that you could pay in $544 and let's say rental income from an investment that you made and have an additional $830,000 inside the policy tax-free without having to take any risk in the policy. Do you think sitting at $1.4 million, we have enough money to finance a couple other mortgages? Definitely. What would happen to the numbers? They would just explode. I'm telling you, this system can just get bigger and bigger and bigger as you grow and as your family grows. And think about it, if this was money coming in from a rental income on an investment that you made, did we make more money in the rents or did we make more money financing the purchase? I'm telling you, the banking business is very profitable. We actually made more money inside the policy financing the deal than we did in the deal itself. Get into the money business. You're harming yourself. And as I said before, look at the death benefit available to Ray's daughter at this point if he was to die 37 years after the policy was opened up and after the mortgage was paid off. Do you think she's okay paying dad back $544,000 if she's going to get $2.1 million? I don't think you'll find her too upset with those numbers. Remember, anything that we're doing in life can be financed one way or another. But if we learn to do it through a system that profits us inside of a mutual whole life insurance policy that participates in the profits of the company, we can do an amazing, successful venture for you and your family getting into the banking business. We're just scratching the surface once again because we have a lot of money sitting in a policy all the way down this time frame that we should be using, but we just got in the policy. We're not doing bad just financing one mortgage. I'd like to see you finance 4 or 5 inside your family. Think on these things. Hopefully by now you're starting to see how much money is being made in the money business and how you need to take ownership of that through a policy. In our next lesson, we're going to discuss how to make investments with policies, like a real estate investment or other things. Because some people say, well, Nate, a policy might not be the best rate of return I could get on my money. But once again, this is not about investments or rate of return. It's about banking. And we can use our cash values to do anything in life, and that includes financing investments elsewhere. So I think you'll really enjoy that one. Thanks for joining us today, and we'll see you on the next lesson.
So, in my opinion, that is an extraordinarily powerful way to create money inside of your own policy. Now, I'm going to hook up my little drawing mechanism right here, and I'm going to show you exactly how we can take a certain amount of money and keep moving it and producing the same results over and over and over again. Okay, so I'm going to go to a whiteboard here, and I hope that you'll be able to see this. Let's see here. Grab a pencil. So what I'm going to try to illustrate here for you is how we can take a certain lump sum. Let's call it 100,000. Okay, so you have $100,000 in it's sitting inside of our policy, and that's in cash value. Now you might be saying, Jeff, well, I don't have $100,000 right now. I'm trying to get you to think a little bit more long term. Okay, so either you build up to $100,000, I'm not saying that you have to have it right now, but in order to gain the kind of wealth we're talking about, notice one thing, that none of these guys, nobody that you ever know that's wealthy or ultra wealthy has ever thought short term. Only concerned about short-term gains. Okay, this is something that you have to understand for your long-term wealth. Okay, and that's what this entire system is about. This is about long-term wealth. So you have $100,000 inside of a cash value policy, and let's say there is a rental property that we're going to buy. So we're going to put that money into a rental. All right. Now we're gonna go and find a good value on a rental property. All right, we're not just gonna go pay top dollar for a property so we can say that we own a rental. Okay, that's not what this is about. This is about finding good value on a property. Maybe buying at when the market's at the bottom, and or maybe you rehab a property and rent it out, stuff like that. Okay, so we're going to build equity into every property that we purchase. But right now, we go into a rental, and we let's say we get it for $80,000, and we fix it up. So we put $100,000 into it. Okay, and so then we fix it up. We use $100K on it, and when it's fixed, it's worth $150,000. Now, how much equity do you have in the property? You have now $150,000 in equity, and you started out. Sorry about that. I don't know why this thing's doing that. I'm trying to figure. Oh, I keep hitting the button. You have $150,000 in equity when you started out with $100K. All right. Now what you're going to do is you're going to rent that property out. Let's call it at 1%, $1,500 per month. And that $1,500 per month is going to go back to pay the policy loan, which you took $100,000. You didn't cash this out, by the way. Okay, all right. So you have cash value in the policy. That cash value is still there. This is what you have to understand. That cash value is still in the policy. You take a $100,000 policy loan. And the reason I say we spent $100K is because we spent $80,000 plus $20K in fixing. All right, so that equals $100,000 now, and now it's worth $150,000. Guys, this is not rocket science, and this happens all the time. I went to a Robert Kiyosaki course a while back, and this happens all the time. We have resources and tools and all this stuff that talk about all this and show you where the properties are, all that kind of thing. But this happens every single day. All right, and in every single market. Okay, I live in a very small town area. I actually live out in the country, but the closest town's a small town, with 22,000 people in it, and there are properties like this available in this market. Okay, so it's even more so in big markets like Dallas, Houston, New Orleans, Austin. Even smaller towns like Lafayette, Louisiana, with 150, 200,000 people. These are all over the place. So this isn't far outside of your reach. Okay, now what do you have here? You have $150,000 in equity inside of this property. $150,000 in equity. When you started out, remember, we started out with $100,000. This is where we're fixing to show you how to multiply the money. So we started out with $100,000, and now we have $150,000. Now we go do the same thing. Can we find two properties? Okay, for maybe $75,000 each. I'd go one at a time. Okay, so now we have. Now look, there are going to be some times when you go to a community bank and they have more than one property available that they're willing to wholesale you. But just for this demonstration, let's say that you now have $150,000. Okay, that's available to you in equity. That means your property is worth $150,000. You go to your local community bank, not a big bank. The local community bank that only services that community. They're going to be a lot more likely to lend money and not even look at a credit report. Once you build a relationship with these people, they're going to look at only your deal. They're only going to look at the deal. So you go to your local community banker and say, "Hey Jim, there's a property over here for $100. Let's say you find a property for $100,000. You know it's going to take plus $20K to fix it up, and you're going to be in it for $120. And you know that property is going to be worth $175,000 when all's said and done, and you have a renter. Okay, and you already have, let's say the property might even already have a renter right now. Okay, when you acquire it, but you're going to fix it up, and you're going to raise the rent on this guy or rent it to somebody else, and you know that you're going to have a rent at 1%, and we're going to call that $1,750 per month. Now, Jim here, Jim Banker, is going to give you that loan, $420,000, against this property. Now, this first property that we bought, let's say it's cash flowing you. What would it be cash flowing? Let's say because you're paying yourself back here. So let's say that it's cash flowing you back into your policy, that you're profiting $500 per month. Now that might be a little steep. It might be $300. Okay, so for some of you more conservative guys, let's call it $300 per month. And this right here, this $120,000 note that you're going to pay off as soon as possible, is also going to at let's call it another $300 per month cash flow. Now, you've got this property here. You have $150,000 in equity. You just bought this property, okay? And that same amount of since you put that money into this property, you've increased it. This is another $55,000 in equity that you put into this property. So that $55,000 plus you still have this $30,000 here in this property, right? That's still $85,000 in equity, plus $600 per month in cash flow. Now, when you buy the houses properly, when you buy the house right, you continue to build equity in every single property. Now look, you don't have to spend $100,000 on a house. You could spend $50,000 on a house and continue to and go a lot further and continue to multiply that money out. So remember, you're paying this back. You don't take out a super long mortgage on this thing. You're paying this back, and you're paying back as fast as possible. You're paying back Jim Banker, and maybe you flip it. Maybe you flip this house and net that $55,000 yourself. So you net that $55,000, pay back Jim Banker, and now you've got $150,000 in equity plus $55,000 in cash flow. And guess what else? We can show you how to do this with no credit and no money out of pocket. No money out of pocket and no credit. Where you just gain, okay, and you increase cash flow. This is the money multiplier system, because guess what? You get it to where you're not even using your own money. We always want to use OPM, other people's money, when we do this. For those of you who have money, I'm concerned about you because I'm afraid you're going to spend it. I don't want you to spend your own money. I want you to spend other people's money. And with BeneShield Financial, you can do that. And right here, in this case, you can do that because guess what? If you even build up your cash value inside your life insurance policy, you are not utilizing you're not utilizing your own money. You're borrowing that money from the insurance company against your cash value life insurance policy, which is continuing to grow on your behalf. Now, when you pay this money back into your insurance policy, it continues to grow bigger and bigger and bigger and faster and faster and faster. Okay? And you can utilize this. I know this whole thing looks very confusing, but I would advise you just to get started. You can do this with other people's money. You flip it, pay it back, and even use rentals to continually multiply your money out. Okay? So, guys, I hope you enjoyed this presentation. I really enjoyed making this part of the video for you. And if you like this, please do hit us up at BeneShieldFinancial.com and let us know what you think. Also, you can follow us on YouTube. I would appreciate it if you go and subscribe to our YouTube channel and click that notification bell so you know whenever we come out with another video. It's going to also drop some value on you. All right. Thank you very much for watching this presentation. God bless. Bye-bye.